turned out to be a year that no one could plan for. During this presentation, we'll walk through the tax impact of the Paycheck Protection Program, federal tax planning considerations for 2020 and 2021, and the implications of state and local taxes in the remote environment and planning considerations. If you're listening to us live, please use the Q&A box to submit your questions, and we will try to address them as we go or at the end of the discussion. The live session qualifies for up to 1 credit hour of continuing professional education. To qualify for CPE, we'll be providing 3 code words during the presentation. These code words need to be entered in the survey link that you'll receive after the webinar. This webinar is also being recorded, so if you need to drop off, you will be able to review the presentation later. If you're watching the recorded version and have questions, you can email your questions to info@bmfcpa.com. I am Melissa Dunham, Senior Manager in Tax Services, and joining me today is Mark Rossetti, Senior Manager in charge, or Senior Manager, State and Local Tax, and Todd Wagner, Partner in charge of our tax practice. I will be beginning with the PPP Loan Forgiveness, the tax impact and reporting. The Paycheck Protection Program is a new and ever-evolving program that, as we know, arose during COVID to provide an incentive for small businesses in order to keep them open and to include the workers on their payroll. The government wanted the workers employed, and they wanted to get the stimulus money into the hands of the people who needed it as quickly as possible and to help support the economy. Our firm has done webinars and advisors on the application process, the compliance program, and the forgiveness applications. The focus for today is on the impact for income taxes as we know it. This may continue to evolve, but we will discuss what we know now and how you can plan for the rest of 2020 and 2021 under the current rules. Anytime we talk about taxes, we start with the particular item we're thinking about and how it's reflected in the financials. Under GAAP, as we understand it as tax people, there are a few different options for reporting the PPP loan. And since there is no specific guidance with this item, so a company is expecting, if they are expecting the loan to be forgiven, in other words, it's probable that it will be forgiven, they will likely be reporting it as other income in 2020. If there is uncertainty, they may be leaving a portion of the loan or the whole loan on the balance sheet at the end of 2020. Our auditors and our accounting teams would be happy to discuss any questions you have on the financial statement impact or how it should be reported in your particular situation. So now we'll start to talk about the tax treatment. The first piece is the easy part. So if the loan is unfortunately not going to be forgiven and it's expected to be paid back, it's just treated like bank debt. So this is normal debt that would remain on your balance sheet. And as those cash payments are made, the interest expense from each of those payments can be deducted on the income statement and the tax return. The CARES Act statute says that the forgiveness will be excluded from gross income for tax purposes. This piece is easily accepted and everyone agrees on this point. But the stickier piece is related to the expenses. The IRS surprised many taxpayers by releasing IRS Notice 2020-32. This said, no deduction is allowable for an expense when the income is not taxable. This notice made many people take pause because this was not the intention of Congress when the PPP was created. If you recall, the intention was to get the money to the people that needed it as quickly as possible. And they did this through the businesses so that people can remain employed. So the intention was from the PPP to be excluded from the taxable income and the expenses to be deductible. But that is not what the IRS is saying. So under this treatment, it's the equivalent of the PPP being taxable income to the businesses. The IRS has taken this stance because they are saying that the PPP is tax exempt income. And since the loan is being forgiven and it's not being treated as cancellation of debt income, they said that it would create a double tax benefit. Many people in our industry and in the trade organizations who are invested in this strongly disagree, and we'll discuss that further in a few moments.
Melissa, isn't part of the reason for the disagreement because effectively by making it taxable, the stimulus burden has in part been shifted onto the backs of employers who, I've had a couple conversations just in the last week with clients who said, we applied for this loan and we did it and we kept people employed, whereas we might have otherwise had furloughs or layoffs. And we used the stimulus funds to support the payroll and keep those people employed. And now by making it taxable, it's the business owner who has to share that stimulus burden. And I think that's part of the reason that so many people are upset.
That is true. And many of the businesses, they've spent the whole PPP amount. So now they need to come up with 21%, 30%, maybe even 40% of that burden to pay their taxes, which is unfair in many people's eyes and not the intent. So, like I said, I will discuss it a little further and go into more detail once we get there. But the IRS in November, so right before Thanksgiving, they came out and they released a revenue ruling 2020-27 and revenue procedure 2020-51. So in the revenue ruling, they solidified their position that those expenses are not deductible. And they went as far as saying, even if the loan has not been forgiven, you haven't even applied for the forgiveness of the loan, but you have a reasonable expectation, so you have all of your support and you believe that it will be forgiven, then those expenses are not deductible in 2020 when they were incurred. So they've provided two examples on this revenue ruling that then we can refer back to implement this if there's further questions. But it wasn't very helpful to the business owners who were looking for those expenses to be deductible. And so the revenue procedure 2020-51, so that one is then saying if you didn't deduct those expenses in 2020 because you believed that the loan was going to be forgiven, but then your loan was denied or only partially forgiven, they have a safe harbor that you can either amend your 2020 return or include those expenses on your 2021 return along with adequate disclosures. So they re-solidified their position and said those expenses will not be deductible. So if you are unsure and you have applied for your forgiveness, but you haven't received confirmation yet, and you may not receive it before your tax returns due or estimates are paid, we would suggest extending those tax returns this year in 2020. If there's any uncertainty, we say extend the return, prepare for the worst, and let's kick it down the road a little bit. The legislation and guidance related to the PPP, it can't be over yet. So we're expecting more announcements to come out, more clarification to come out. We have a lot of unanswered questions in our practice. And as I'm sure many of you know, earlier this month and all throughout the summer, the AICPA, state CPA societies, trade organizations, they've been contacting Congress. They've been writing letters. They've been writing articles regarding the PPP expense and the treatment. They sent letters to the US Senate and letters to the House appealing to Congress to pass legislation before the end of the year so that the businesses can prepare. The IRS treatments of expenses are really the holdup for many businesses in their year-end planning. And they're really hoping that Congress will push it through in some year-end packages, such as the new PPP package, the stimulus package that's being talked about. So they don't want businesses to have a surprise tax increase like we discussed earlier. When they spent the money throughout 2020, the businesses thought it was for payroll, for their rent expense. They didn't expect that they would need to use a portion of that to pay taxes. So it's creating an undue burden for many small businesses after they've already spent the money. The rules have changed.
Yeah, my understanding, Melissa, is in the couple of those bills that are in Congress right now that both deal with the stimulus, but also I think they have to pass something today to keep the lights on, so to speak, as we otherwise have a government shutdown. And I'm hearing that they're going to pass something that kicks that to next week. And that I think one of those packages includes the language that you were referring to. I'm not sure whether it's in the other one or not, but I think that there's some hope that perhaps it'll be included as part of this year-end legislation.
Yes, we're hoping that the parties can come together, settle on those terms, settle on their differences, and be able to pass that next week or hopefully the week after, before the end of the year, so that when the owners of the businesses are filing their tax returns, they have some clarity before they make a payment on January 15th. It's very hard for people to plan for running these tax projections and even thinking about where they want to spend their money. Do they need to hold it back to pay a tax bill, or can they pay more of their payroll, pay bonuses to the employees, or use that money where they need to? So some AICPA leaders in our industry really think that this will pass, like we just said, but we are hopeful. But under the current environment, the current rules, the unsettled disagreements that many people have in the Congress, we're hoping that they can come together. But until then, it leaves us recommending to our clients to play by the rules as we know them now. So we have many unknowns. We would like to see more guidance on how this will be reported on the 2020 tax returns. So are we going to be removing those wages from the tax return? How it will come through, especially if there's other tax attributes to worry about, such as the R&D credit, the work opportunity tax credit. And if you haven't filed for your forgiveness yet, and you do have an R&D credit or work opportunity tax credit or similar item that is included on your return, we would recommend putting in the forgiveness application something to say that the R&D credit, those wages that are pertaining to that, are not the ones that are being forgiven. If you have enough wages in other places, to try to maximize those credits. So feel free to reach out to us or our counterparts in our organization that help you to look at that wording and to look at your tax situation.
And Melissa, that's because if the expenses are non-deductible as a result of the IRS's current position on the PPP loan, then they also wouldn't be able to be used for those work opportunity tax credits or the R&D credit, correct? Because those credits drive off of certain qualified wages that meet those definitions.
Correct. That's what we think is probably going to happen. And again, we would like to see some guidance if those expenses are not deductible that would reinforce that conclusion, or maybe those wages could still be used for these purposes. But until then, we don't know. And we would like to position our clients for the best possible outcome under the current rules. There's a lot to consider with the year end, and if there's any uncertainty, especially when the returns are being extended, we would recommend extending those returns rather than pushing them through to file on time, because we have too many unknowns as they are sitting right now.
And for purposes of estimated tax payments, obviously for returns that are for calendar year taxpayers that aren't due until March or April, C corporations are making fourth quarter estimates now, and we have individuals who are going to have a fourth quarter estimate due in January. Can you talk a little bit about how to plan for that as it relates to what do we have to do right now before we have the legislation?
So today, as we're talking to our corporation clients that need to make a payment on Tuesday, we're we're recommending they play by the rules unless they do believe that this is going to be pushed through, that it will be in the package that is passed for the next stimulus payment. So under those circumstances, we need to get together on a comfort level to see, do they like to be a little risky? Are they okay paying a little bit of interest or a small amount of penalty if they're underpaid? Or do they want to make sure that they're safe? We need to look at the whole package. Are they paid in at their safe harbor from the previous year based on their circumstances? Or are they expecting income to be down this year, so they're not using their safe harbor payments? There's a lot of items to consider, and we would be happy to discuss those with you in your particular situation. But for the payments that we're calculating to be due in January, I'm giving the worst case scenario. Those expenses are not deductible. And if they are deductible, this is where we would expect you to be. And I'm not recommending that those payments be paid early. Wait until January 15th. Let's see if anything gets paid or passed and included. Do we have more guidance that will be helpful to the clients?
I think that's all good, Melissa. I think it's important to keep in mind too, that when we're talking about the estimated payments, the exposure really is interest. I mean, they call it penalty, but we're really talking about interest, and the penalty interest rates, if you will, are just a little bit north of prime rates. And with interest rates being relatively low, yeah, the exposure on having a late payment, so to speak, may not be that significant, depending on what the alternative cost is of making those large payments and having the funds tied up until the return can be finalized.
Especially if you don't have the cash flow to make the payments.
Right. Right.
So if nothing's passed by Congress and it's not included in the stimulus package, there are some of the professionals out in our field that completely disagree with the IRS, and they're citing out that words in the tax code matter, and that are professional, and they're writing articles in the industry, and they're speaking to different groups saying that the IRS is completely wrong. They're saying that if the loan isn't forgiven until 2021, it can't be considered income or tax exempt income in 2020, and that those expenses should be deductible since those facts of that forgiveness haven't happened. They're citing other cases in the court that have been passed through the tax courts and other code sections to support their position. So if you are in that camp and you want to go down that path, we can look at your tax situation, but understand that you would need to consider, and we would work through it with you, if there's substantial authority for your position. And if this would be an uncertain tax position that would need to be disclosed in your financial statements and potentially reported on your tax return if you're not following the revenue procedures that have been issued by the IRS, or the notices saying that those expenses are not deductible in 2020. And if you potentially report that and the IRS challenges it, there could be some penalties for taking a position that's contrary. And consider, would you go through and take the case to court to challenge it? But hopefully that won't happen. Hopefully Congress can come together and go with their original position and the interpretation of the PPP when it was issued, saying we were trying to get this stimulus money into the hands of the people and the businesses to keep their doors open, keep people employed during this pandemic. And they use the businesses as a mechanism and not penalize them by having them share the burden of the whole stimulus package by paying tax on these items. So with that, I am going to give you your first code word, and that is program. So again, the first code word is program. So I do not see any questions that have been submitted, but feel free to submit them throughout. And I'm going to pass the presentation along to Todd Wagner, who will then talk about federal income tax planning in this post-election atmosphere.
Thanks, Melissa. Yeah, I think it's important as we start to discuss planning that we have a good handle on the current landscape. And I think people are pretty familiar with what the current rules are, well, I should say the current rates. We're still getting comfortable with what the current rules are because guidance continues to come out. And I even noticed this morning some final regulations issued relative to the Tax Cuts and Jobs Act that was passed back at the end of 2017 and primarily took effect beginning in 2018. But of course, we have top individual rates right now of 37%, a top corporate rate of 21%, and capital gain and dividend rates of 20%. The Biden tax proposal, as he was campaigning, included some pretty significant increases to taxes in a variety of manners, from increasing the individual rate to 39.6, having long-term capital gain and dividend rates equal to the ordinary rates for taxpayers making more than $1 million. He wanted to go back to the pre-Tax Cuts and Jobs Act regime as it related to itemized deductions. And then another important part of the Tax Cuts and Jobs Act was this qualified business income deduction, which was meant to level the playing field for small business owners, those who are taxed as a flow-through business, an S corporation, a partnership, or even a sole proprietorship. In reconciling that top individual rate of 37 relative to the corporate rate of 21, we had this 20% deduction that applies to non-service businesses. And he was planning on phasing out that deduction for those who had income greater than $400,000. Also wanted a corporate rate of 28% and an additional tax on Social Security. Melissa, if you could shift to the next slide, please. So those proposals alarmed a lot of people, and particularly in the lead up to the election, where there was certain risk, if you will, depending on where you were coming from, that there could be a blue wave, so to speak, and that all of those changes would be implemented very quickly. Well, post-election, we have President-elect Biden being declared the winner, and we don't know yet, though, in the Senate. And we have runoffs on January 5th that are going to determine in Georgia the outcome of those Senate races. Right now, the Senate is 50 for the Republicans and 48 for the Democrats. Of course, if the Democrats win both of those runoff elections in Georgia, the tie-break vote in the Senate will be cast by Vice President Harris. And, despite that, there are many that feel, given how close the elections have been, that even if the Democrats prevail in those runoff elections, and to point out how close everything is, the Republicans picked up a lot of seats in the House. I didn't realize until just recently, this is about as slim a majority in the House as we've ever had. And it's hard to believe on the heels of just having had an election that those in Congress are already looking ahead to the midterm elections in 2 years, at which time every House seat is going to be up for grabs. And thinking about that, they're considering whether they want to spend their political capital on proposals to raise taxes significantly in the near term. If we remember that most of the individual provisions in the Tax Cuts and Jobs Act expire after 2025. So for those who were advocates of higher tax rates, they're going to get those higher tax rates anyway by doing nothing. And the question is, do they want to wait until after 2025 for that to happen? I think that there's a general feeling that rates have to go up. Okay, there's a tremendous amount of money being spent on stimulus and appropriately so, but that has to be paid for somehow. And the amount of the deficits are very significant. And I think the question is how to have those increases in rates in a manner that doesn't unduly burden the economy and slow down economic growth. Most of the folks that I've been speaking with and political advisors in Washington believe that it's unlikely we will see significant rate increases in the near term. Now, of course, that being said, everybody hedges their bets, and it's similar to what Melissa was referring to in terms of the PPP language, being slipped into a stimulus bill. There's always the possibility that a tax rate increase slides into one of these stimulus proposals, and it becomes difficult to vote against. But the overall tone of what I'm hearing is that it's unlikely that we're going to see significant rates in the near term. And if you want to go ahead to the next slide, I think that's important as we look at tax planning right now. Okay, decisions need to be made right now to the extent that businesses have influence over accelerating income or deferring income between tax years, and accelerating or deferring deductions. So a lot of this is going to depend on what your own personal view is of the political climate, and how likely you believe that it is that rates are going to go up significantly. The overall objective is we want to optimize effective rates. What's that mean is we want to recognize income in low tax years, and we want to recognize deductions to offset high tax or high rate income. And if we think rates are going up, well, that would incline one to try to accelerate income, which is counterintuitive. If you think that you're going to be in a lower bracket, then of course you would want to defer. And go ahead to the next slide, and we'll talk about some of the planning around that. Some of what we also want to look at is there were provisions in the CARES Act that related to net operating loss carrybacks that changed the rules for those. In the Tax Cuts and Jobs Act, it changed the rules from being a 2-year carryback and 20-year carry forward to eliminating all the carryback and even limiting the amount of the net operating loss that could be taken in any given year. Well, now is to provide stimulus, we can carry those losses back 5 years, losses incurred in 18, 19, and 20. So on that theme of taking losses and deductions in the highest rate tax year, you really have to consider, if you have a loss in 2020, or you had one in 2019, do you want to, because you still can, elect to forego that loss carryback, or do you want to go ahead and take it back 5 years? We had a situation with a client, actually related to 2019, where they had a very significant loss. And prior to filing the return, though, we talked through the implications of taking that 19 loss back to 14. And then rolling it forward 14, 15, 16, 17, and 18. And one of the things that would have happened there, it happened to be a flow through business, and so the loss was on the individual returns, is that we would have lost the benefit of itemized deductions that happened in those earlier years. And we would have lost the benefit of graduated tax brackets upon which the income in those prior years was taxed. We would have lost the benefit of domestic production activity deductions in those prior tax years. And so when we considered the effective rate at which we would have benefited those losses, and then we also looked at forward anticipating significant income in 2020 and 21. And even though it would have been nice to have the refunds from prior years, we concluded that the actual rate at which we would have benefited the losses, even though the top rates were higher in prior years, but given everything else that factored into the actual tax paid, we were better off to forgo the carryback and just take the losses forward. And Melissa also referred to cash flow considerations, right? And that was very important in that fact pattern as well, because who knows how long it would have taken to process those loss carrybacks. And instead, we had the benefit from a cash flow standpoint by taking the losses forward of eliminating estimated payments in 2020 to have an immediate cash flow benefit, which was very important for them to continue to operate their business. So I use that as an example, but it's really important in looking at this planning at year end to understand the entire picture, not just looking at what's happening within the current tax year, but understanding where do you think you're going to be in the future, and also to keep in mind that yes, longer term rates are probably going to be going up. Melissa, if you'd go to the next slide, we give some examples of different planning strategies. There's been some discussion, for example, about converting Roth IRAs, converting IRAs to Roth IRAs, which would mean recognizing income today on the value of your IRA. Of course, once it's a Roth IRA, then you don't have required minimum distributions. There are no taxes when the funds are withdrawn, so long as you're more than 59 and a half years old. I remember back when the Roth IRA rules first came into effect, and the ability to convert, and a lot of investment advisors were going around and trumpeting this as the greatest thing since sliced bread, and everybody should convert to a Roth IRA. And they had these models that projected out 50 years into the future, your grandkids aren't going to have to pull this out. And so the power of the compound growth on a tax deferred, tax-free basis would more than offset, even on a present value basis, the tax cost today. And what always troubled me about that was that it made big assumptions as to what rates were going to be in the future and how funds were going to be used in the future. And so I always asked her, do you have great certainty that your grandchildren are not going to pull this money out of the Roth IRA? Do you have great certainty that the tax rules aren't going to change? And of course, what did we have in 2020? We had the Secure Act, which changed those rules and said that you have to take the money out after a certain period of time, once you pass away. And I think if those models were looked at under the current rules, I think we would find that they didn't work. Another thought is to distribute funds from trusts. Trusts reach the highest tax brackets very, very quickly. And one way to minimize the tax rates is to distribute to the beneficiaries to the extent that the beneficiaries are in a lower tax bracket. But again, you have to consider other slide mentioned environmental factors. There are non-tax factors that are very important as well. There are a lot of good reasons to hold funds in trusts, from asset protection to, sometimes you don't want an 18-year-old to have access to a lot of money. My children happen to be 18 and 20, and I know that I would be leery about putting too much money in their hands too soon. So these non-tax factors have to be layered into your thinking. Harvesting capital gains. Again, if you feel that capital gain rates are going to go up substantially, it's counterintuitive, yes, but you might want to recognize gains in your investment portfolio, which would require you paying tax today on that. Or if you've gone through a liquidity event, a significant transaction that involves payments out into the future, you can elect out of the installment sale treatment and choose to recognize that income now. Similar concept with different forms of equity incentives or deferred compensation, to the extent that you have options that you otherwise were not planning to exercise. When you exercise them, it's taxable income, and you can choose to accelerate that now. For businesses, accounting method changes. There were some favorable things in the Tax Cuts and Jobs Act, like the ability to use cash method of accounting and certain methods as it relates to inventory and capitalizing costs under Section 263A. Some taxpayers didn't have to do. Had conversations with some other clients that might be eligible, for example, to switch to the cash method. And we've said, you know what, why don't we wait? Because if we think rates are going up in the future, making that method change in a higher tax rate year can be more beneficial. Required minimum distributions. We are allowed to defer those this year under the CARE Act. You don't have to take an RMD. But, I've seen a number of clients who are still taking those minimum distributions. And part of the reason they're doing it is because they have certain charitable contribution commitments that they've made. And the cash flow method of funding those commitments is with their required minimum distribution. So up to $100,000 of RMD. As long as the funds go directly to charity, you don't recognize that as income. It effectively gives you a deduction as well for Ohio purposes. I mean, Ohio doesn't allow itemized deductions. It starts with federal adjusted gross income. And so by giving those monies directly to charity, you don't pick it up as income in Ohio. So sometimes, and talking about maximizing contributions, even though rates may be going up, a number of clients have chosen to still make significant charitable contributions this year if the market is up. And they have appreciated positions in their portfolio, making use of a donor advised fund to deposit appreciated stock and take the charitable deduction today and then distribute funds to the charity over time into the future is a valuable strategy, and one that I am still seeing clients do quite a bit of, despite the fact, again, we may see higher rates. So I think it's still important to look at the increased level also of itemized deductions that were afforded by the Tax Cuts and Jobs Act. So that's about $24,000 for a married filing joint couple, a little over $12,000 for an individual. To the extent that you're not going to come close to those in any given year, then maybe it does make sense to maybe not make those charitable deductions contributions this year and double up in another year, or vice versa. Maybe accelerate some of those charitable deductions in this year so that you get over that standard deduction threshold. Go to the next slide, Melissa. I also want to talk about estate taxes briefly. One of the other proposals by President-elect Biden was to lower the lifetime exemption. The Tax Cuts and Jobs Act increased it from $5.5 million to about 11 million. It's indexed for inflation, so it's about 11.7 million now. And he had proposed to peel that back actually to levels below the Tax Cuts and Jobs Act level, so below the 5.5 million. At the end of 2025, it will revert back to roughly 5.5 million. And the IRS has previously come out and said it's a use it or lose it situation. So to the extent that you make gifts now that would use that $11.7 million lifetime exemption, if the exemption comes down in the future, there's no clawback. Okay, there's not going to be a pulling back of that amount as a taxable gift. There are a number of strategies. We don't have time to get into them in detail today, but we'd be glad to discuss them with you that will allow you to maximize that 11.7 million now, move funds outside of your estate, and then if it's pulled back, whether it's via future legislation or the expiration in 2026, you will have again moved those funds out of your estate and save significant dollars with the state taxes. Spousal lifetime access trust is one that I'm talking with clients significantly about. Of course, there are irrevocable life insurance trusts and charitable lead trusts are some of those strategies. Things that will continue to work, estate freeze techniques like grantor retained annuity trusts and intentionally defective grantor trusts continue to be solid planning ideas. And again, would love to talk to you more about those. Those are especially beneficial, the GRATs and the IDGTs, because of the low interest rate environment. The way the mechanics of those work, they are especially effective if you have assets that you think are going to appreciate in value significantly more than current interest rates, which I think the midterm applicable federal rate is somewhere, it's a little less than 0.5%. So significant opportunity there. If there are no questions, then, let me give you the code word. The code word is election. The second code word is election. And if there are no questions, then I'll turn things over to Mark Rossetti, who can talk to us about state and local tax.
Thanks, Todd. Yeah, I have about 5 key issues that I want to cover as far as state and local tax law changes and things that are applicable to 2020. Before I get into the slides, one comment I wanted to make was related to the PPP loans. and let people know that most states piggyback off federal taxable income. So to the extent that there are those expenses do not get reversed out, and they do become subject to tax at the federal level, most of the states will piggyback off of that, and so you'll be paying some state tax on those PPP loans as well. Now, if congressional action doesn't take place, there could be states that choose to legislate that out. But as it sits now, I'm sure they're all waiting to see what Congress does before they make any tax law changes at the state level. But just wanted to throw that out there. So the first item I want to cover is market-based sourcing. So market-based sourcing is a concept that states have adopted over the years, and it relates to service-based businesses. So we're not talking about businesses that sell widgets. If you sell tangible personal property, the sourcing rules have always been destination. Where are you shipping that product to? But on the service side, 10, 15 years ago, all the states were cost of performance. So what that meant was, it's where did you perform the service? So as accountants, if we're sitting in Ohio and we're cranking out tax returns for our clients, then if Ohio's cost of performance, they would get to tax us on 100% of our revenue. But states slowly realized that implied that you had physical presence. So if you're performing the service within a state, it means that you are physically there. And so states wanted to be able to tax service-based businesses that weren't physically present within their state. So they moved to this market-based sourcing technique. And basically what it says is there's two schools of thought with it. You can either look to where your customer's located. So again, take the accounting profession. Let's say we have a client who is located in the state of Texas. Well, if we're performing services for that client, then the state of Texas could potentially drag that service revenue into the numerator of their apportionment factor for our firm to have to file there. The other school of thought is to look at the benefit received by your customer. So for instance, again, we have a client that's located in Texas, but we're filing a California tax return for them. Well, now California could say, well, the benefit of your service really was because you filed a tax return in the state of California, and therefore the amount of revenue you generated by filing that California tax return should be in the numerator of our state factor. So states are getting creative in ways to drive up apportionment for service-based businesses, and this is the way that they're all doing it. So just for instance, in 2020, there's 7 new states that have adopted market-based sourcing of some sort. Those are listed there on the slide. I won't read them to you, but with these 7 states, we're up to about 2/3 of the states adopting market-based sourcing, and about 1/3 of the states still on the old cost of performance method. Now, this creates double taxation in some scenarios. It can also create an opportunity for you to have zero taxation, depending upon where you're situated, where the states are that you're performing services, both for the customer and where the benefit's being located. So there's all sorts of complexity surrounding it, but it's an area that most of the time gets overlooked. It gets overlooked because when companies pull their sales by state report, they pull it just like they historically filed it or pulled that report. And generally, they don't consider the fact that there's 3 different buckets that need to be pulled and to be analyzed to properly file in the states in which you have nexus in. So it's something that you should take a look at if you are a service-based business and you're not performing the service where the customer is located or where the benefit's located, you may have a situation where you have to look at this in more detail. Obviously, for your contracting type companies where you're performing a service and that service is erecting a building or doing something along those lines, generally all 3 of those buckets are going to be in the same place because you're performing a service, the customer's there, the benefit's there, everything. But if you're in a unique industry, it does behoove you to look at that in more detail. So moving on to the next slide, we'll talk about income tax nexus and how Wayfair has changed the landscape to some degree for both sales tax. I think everybody knows what Wayfair is now on the sales tax front, and as far as what it did for nexus, it eliminated the need for physical presence. But these states are looking at the substantial nexus determination within Wayfair, and they're saying, well, substantial nexus isn't just related to sales tax. It could also relate to income taxes. So there's been 4 states that since Wayfair came out in June of 2018 that have adopted Wayfair substantial nexus standards for income tax purposes. Now, again, if you're selling tangible personal property, you're selling widgets, you still get federal protection of 86272, which says, state can't tax you unless you breach the solicitation of sales. So you have to do something more than soliciting sales. And obviously, if you're just shipping product remotely from one state in all over across the country, that's not going to trip you up. But where Wayfair does come into play is when you're a service-based business. So again, what Wayfair indicated was if you have a number of sales within the state to create the requisite nexus, and generally the threshold's $100,000, but it could be more. On the income tax side, a lot of states have defaulted to $500,000. But what they're saying is effectively, you could have no physical presence within a state. You could have no activity within the state other than you're sitting in your home state preparing tax returns or performing services, and it relates to their state. And if they have Wayfair Nexus and they also have market-based sourcing, they can pull you into filing into their state based upon these factors. So Hawaii, Massachusetts, Pennsylvania, and Texas have all implemented Wayfair type Nexus. Now, why only 4 states if this is such a great concept? Well, other states I'm sure are sitting on the sidelines and they're waiting for these 4 states to get challenged. So, and I'm sure there is challenges being taken in these states to look at whether or not this is constitutional. And once there is a definitive answer, and if it does pass muster in these 4 states, I can see all the other states coming up with some sort of Wayfair income tax nexus to pull people into their state. It's almost similar to when Wayfair was decided on the sales tax front. For a state to be able to enforce it, they had to have Wayfair statute or Wayfair nexus on their statutes. So all of the states, except for 1 or 2 so far, have adopted Wayfair for sales tax nexus, and they did it pretty quickly, knowing that they could get additional tax revenues. So moving on to the next slide, we're going to talk about one way that the states have gotten creative to circumvent the SALT deduction at the federal level. So with the Tax Cuts and Jobs Act, when they instituted that $10,000 SALT deduction cap, it really had an effect on states that have a higher tax rate. So the states, especially in New England area, that have high tax rates, were thinking, well, our residents are going to look at this and they're going to go, I can't deduct my state taxes anymore. Maybe I should think about moving to a lower tax state or moving to a state like Florida with no income tax. And so they're scared that their high net worth individuals are going to move out of the state. So one way to circumvent the SALT deduction is to target business owners who own pass-through entities. And so it's a pretty novel idea. It's a quick fix. Business income that flows through a flow-through entity generally flows to the individual and gets taxed at the individual level by the states. But the states realize, well, what if we stop the taxation at the entity level, and therefore the income doesn't flow to the individual, and we can tax it at the business level? And by doing so, we can circumvent that SALT deduction at the individual level. So there's been 7 states, all listed there, that have instituted some form of either optional or mandatory entity level taxation. And so the entity files, they pay income or they pay taxes based on their income. And then that deduction is taken at the business level. So it never even, it gets deducted there and you don't have to worry about it at the individual level. Now there is a little bit of a whipsaw to that in that, generally if you live in a high taxing state and you pay taxes at the individual level, you get credit for taxes that are paid to other states. So if the taxes are paid at the entity level, you won't get that at the individual level anymore. But, it depends on your facts and circumstances. It could be beneficial for you to file at the entity level and pay, or it could be beneficial for you to flow through that income and get taxed at the individual level. It's just going to depend on your specific facts and circumstances.
Mark, it occurs to me as you were talking about that if you have a flow through entity, partnership or an S corp where you have owners who live in different states, who have different fact patterns, you could have situations where it's beneficial for some owners to pay it at the entity level and for other owners to have it flow through. And so I imagine some kind of analysis should be made in those situations.
That's exactly right. We do have a client who's in that situation. One shareholder's in Florida, so they don't worry about credit for tax paid to other state. And the other one is in New York. And obviously New York's a high taxing state, so that credit becomes pretty valuable. So yeah, sometimes you have conflicting interests on whether or not it makes sense to do at the entity level. So an open dialogue and analysis needs to be taking place so that way everyone understands the ramifications of opting into this type of taxation, if it's optional, obviously. But great point. So moving on to the next slide, we're going to talk about a hot button topic, and that's work from home and what that means for the individuals and for companies that have to withhold on those individuals. So a number of states have issued guidance of some sort indicating that if employees are working from home and it's in a different state from where they work, withholding does not need to be shifted over to the home state. It could be continued to be withheld to this primary place of work or where the employee used to go into work every day. Other states have been sitting on the sidelines, not issuing guidance, so it's a little bit more difficult to understand how things would roll out in those states. But Ohio came out and for municipal tax purposes, issued some guidance that is both good and bad, depending upon how you're situated. But effectively what Ohio said was, during the governor's emergency order and for 30 days thereafter, if it gets lifted, you got 30 days to revert back over. If your employees are working from home due to COVID-19, then you can continue to withhold again to the primary place of work. So for instance, myself, I work in the Fairlawn office. So I get withheld to Fairlawn. And for all the days that I work from home, I'm continued to be withheld to Fairlawn because we're working from home under COVID-19. If a company though shifts their practices and they say, you know what, work at home is a good thing. Even if COVID-19, the emergency order gets lifted, we're going to be permanent work from home, and they issue a directive to their employees, then at that point, you have to shift the withholding over to where your employees are located. And so now you're going to have a lot more withholding obligations in more cities. And on top of that, because you have employees that are working within those jurisdictions, you're going to have a net profits tax filing obligation for the company in all those cities. So it really does complicate things as far as where you need to file and where your footprint is. So you should analyze it and decide how you want to go forward with either a policy or continue to be under COVID-19 restrictions. So to piggyback off that, the next slide, we're going to talk about centralized filing on the Ohio Business Gateway for net profits tax returns. So Ohio instituted a few years ago the ability to file one return on the Ohio Business Gateway for all of your city level filings at the entity level. So it used to be you had a bunch of home rule jurisdictions where you'd have to file a return in each individual city. You had your two centralized collections, which are RETA and CCA, and you could file in a bunch of cities for those jurisdictions. But what Ohio said is, why don't we streamline this? Why don't we allow like a one-stop shop where you can opt in, and if you file in 300 cities, you effectively report, the items of income and deduction one time, and then you just apportion to every city that you're in based on your property, payroll, and sales. And so to do this, you have to opt in. And to opt in, you have to do it by March 1st of the year in which you want to file the return. So for instance, for the 2020 tax year, you would have had to have opted in by March 1st of 2020 to be able to file on the Ohio Business Gateway in the next busy season, next spring. So because of COVID-19, and because of this work from home issue, you have a lot of employers that maybe only filed one city return. And so opting into the Ohio Business Gateway was, well, we're going to file one return either way, so it really doesn't matter. But if you have shifted your employees to permanently work from home, and now you have 30 cities that you got to file in, well, now it makes more sense to opt into that centralized filing, but it's too late. And March 1st was the deadline. So it's really important to know that March 1st deadline and what needs to be done prior to it. So if you are in the of the mindset of my employees are going to work from home, and maybe that's for 2021, maybe you haven't shifted over yet, just know that it's going to increase the amount of net profits tax filings you're going to have. And so you want to make sure you opt in by March 1st of 2021 for the 2021 tax year.
I think it's also good, Mark, because a lot of folks who are in that situation may not realize with CCA and RETA, at least you may have multiple cities, but it's one return that you're filing for a number of the cities that are covered by CCA, by RETA or CCA. So you really need to look at which cities it might apply to in that analysis.
Yeah, and payments become a lot easier. You make one payment on the gateway, and you basically allocate that payment across all your cities. Whereas, if you're filing in 30 different cities, you'd have to make 30 different vouchers, make payments, and so centralized filing does afford a lot of benefits to companies who, again, are in a lot of jurisdictions. Now, your construction contractors of the world that travel around city to city, those were always filing in a bunch of cities. But you have cities or companies that are static in one city that have normally only ever filed in one city that are now going to be subject to filing in a bunch of cities. So the centralized filing can be a great tool for them to reduce that compliance burden. And with that, that's the end of my slides. So I will give you the last code word, which is nexus.
I saw we did have a question in the Q&A. I think it was addressed, Mark, in your comments. And I just would say that we certainly can follow up separately if there's a specific application question as relates to that topic.
Sure.
All right, and so we want to thank everyone for joining us today. Please remember to follow the survey link, which will be emailed out to you after this webinar closes, and it's on the screen. If you have any additional questions, please send them to us at info@bmfcpa.com. Thank you.
Thanks.
Take care, everybody.